This is Mike Swanson of Wall Street Window with you today. I want to talk with you right now about the potential end game for the stock market and the bond market. Where is this all really headed for? Now, last week I put up this chart and had a little bit of a discussion about it. The S&P 500 is in a bear market downtrend channel. That's the two blue lines on the chart going diagonally down. And I gave reasons to explain why I believe this bear market's going to actually end next year when the current rate hiking cycle comes to an end. Now, I'm saying next year because that's what the bond market is pricing in. And I go with what the market says, not, I don't come up with these predictions out of thin air or tell you what I think I wish would happen, but what the market is actually suggesting is going to happen. And the Fed fund futures market is showing that the path of interest rate hikes is to go over at least 4%. And now it's pricing in a good chance we're going to go over 4.5% on interest rates for the Fed funds rate next year. And the stock market is being hurt as interest rates go up. And I don't, this whole process is why I'm saying next year, not this week, not October, but the bear market ending next year. And I also showed you these retracement support levels to keep eye on for a potential bottom, price point bottom. The first one is around 3,500. It represents an approximately 50% retracement of the 2020 low and the recent high set around New Year's. Below that is the two-thirds retracement level, around 3,250, just about. And I think that's more likely where this is headed to. But I'm not trying to predict the exact price bottom. It could be worse, it could be better. It's more the general direction. But the big question to me is what happens after that? That's the end game. And no one's really thinking about that. I turned on CNBC this morning and Jim Cramer was on there and he was saying people need to stay in the market or even buy more because the market's going to go up when the Fed stops raising interest rates. He listed like four events that would make the market go up. Another one was if the Ukraine people defeat Russia. Well, neither one of these things is going to happen next week, and it's not clear that Ukraine's just going to beat Russia and completely. It's a very uncertain scenario with no signs that the end of it is coming soon. So, this is what I talk about, like, it's sort of like wishful thinking, wishful talking. And more concrete thinking is, look, the path of interest rates is not that it's going to end at this next meeting Wednesday, but next year. So we're locked in the downtrend channel. But the end game is what's important. And with that, I want to talk with you about interest rates. What you're looking at here is the 2-year Treasury yield. And it goes, the Fed hiking cycle actually tends to follow this, what traders are doing with the 2-year bonds and whether they're making yields go up or down. And, yields now on the 2-year bond are at 3.85%. So, and with interest rates by the Fed set lower than this, where they're going to go higher. But what's important to note right at the moment is I want you to notice on this chart that in 2018, these periods I circled saw violent stock market corrections. Of course, there's one in 2020, but it's the ones before that I want to make note of before we get to 2020. 2018, the stock market fell about 20%, and the 2-year yields are falling with the market. In 2016, there was a 20% correction that began in July 2015. The yields were falling with the market. 2011, there was a flash crash. Yields fell with the market. 2008, yields were falling into the crash, and it was going on during a bear market. The point I'm trying to make is now is a different moment because in the stock market, we're in a bear market, but yields aren't going down. They're going up, something that people in the stock market have never seen before. Almost everyone that's trading the markets, talking with you about the markets, because you got to go back really to the 1970s and 1980 to find a situation similar to what's happening now in the sense of yields going up and the stock market going down. People were telling you the Fed would never let this happen. The Fed would lower rates if the stock market fell. Well, they didn't, but they're telling you that because that's what they have been doing in their experience in the market, and it done in the 4 periods I circled on this chart. I could have put a circle in 2020 too, and that would make 5 periods. So here we are. And there's an expectation that at some point the yields will go down, the Fed will stop raising rates, and they will so-called pivot, and then the stock market will explode. And they're telling you in June that was coming. Now, no one knows. Everyone knows it's not coming next week, but they're telling you in June it could be coming by now. No, they're wrong. And the stock market rally failed. But here's a possibility that no one is talking about with you, and that is, what if these assumptions that the yields are just going to go down aren't true? Because the inflation is real, it's systemic, and what if it doesn't go down as much as people have predicted? I mean, if their predictions have failed so far, what if the CPI rate doesn't go to 2%? What if it doesn't even fall to 4% and we get yields around 4%? Well, if that's the case, interest rates aren't going to fall that much. So what does that mean for the markets? That it doesn't mean the stock market's going to fall endlessly in a bear market. You see, bear markets do come to an end when there's panic selling in a market, when there's a washout in the market, when stocks really do get cheap. And that is going to be how this one comes to an end too. And even when they end like that, the news could remain bad, the economy can remain bad, and the stock market could go up anyway. That's essentially what happened in 2009. So it's not the end of the world if interest rates don't go back down like people want to keep saying they will do. There's a big danger in the market, and that is that we're not just seeing rates go up because the Fed's fighting inflation, but we're also seeing them go up because we're really in a secular bear market for bonds and rising real yields being in a bull market. So any stop in the rate hiking cycle in rising yields will just be a pause that could last, months, a year, 2, maybe 1 or 2 or 3 rate cuts. But after that, the yields start to go up again. Much is what that is basically what happened in the 1970s. So we're not going to return back to the type of market environment people saw, over the past 20 years up until this year, when the yields begin to rise relentlessly and the Fed has not, has been raising rates with a bear market. You got to, if you want to navigate these markets, understand not just what's happening, but where things are going. That's the story, or that's the trend that you need to keep your fingers on and understand why it's happening. So here's something I want to suggest to you, something I'm going to be thinking about. This bear market will end. I think it's going to end next year and probably, in the spring, but regardless of the timing, most people are thinking that when it ends, yields will go down, and bonds trade opposite to yields. So when yields go down, bond ETFs, such as the one you're looking at here, TLT, and bond funds go up. But what if we get to a period where the market bottoms and the Fed says, okay, we're going to stop raising rates? Everyone in the market is going to think and expect that bonds and bond funds will therefore rally. And there'll be a big rally in the bond funds. Yields will go down, stocks will go crazy, and so forth. And they're basing this assumption on another assumption, that is that everything you've been seeing in the bond market this year has been totally controlled by the Federal Reserve, that the bond market is doing what the Federal Reserve wants it to do. The Federal Reserve wants to raise rates, so yields going up are simply part of a natural rate hiking cycle. But what if instead yields are going up because of inflation and the Fed is simply following the bond market? It's not really controlling anything at all. It's just raising rates because it's responding to what the yields are doing in the bond market. And what if, when the stock market bear market comes to an end and the Fed says we're pausing, the yields don't go down, but instead, what if they go up? What if instead of rallying, bonds go down? That would represent the Federal Reserve essentially losing control of the bond market due to worries over unstoppable inflation or the size of the government debt. How would you deal with that? Well, I still think that after this bear market ends, even if those things happen, stocks could rally, but bonds would not. Bonds would continue to act poorly. Bonds would go down. And that possible scenario is something to keep in the back of your head as the next 6 months play out. And it suggests that there is still a long-term risk in bonds as an investment in this market. And at some point, people will be looking for an alternative to that risk factor. And the alternative is gold and silver. Now, gold and silver have been pulling back this year, or for the past since they made a peak in the spring. But one thing it's worth realizing is that while they've been pulling back, they're still performing better than the stock market this year. This is the gold divided by S&P 500 ratio. It's up year to date, and it's even up the past month or so, despite the fact that it's falling or has corrected or fallen more. That's because gold is outperforming the stock market. When gold is going down, it's going down less than the stock market, and that's helping it continue to perform better. It's showing powerful relative strength in sectors, assets, funds that do that when the stock market's in a bear market tend to explode and continue to outperform and go into a wild, very profitable bull market for those that invest in them on the next bull cycle. So I think that's an answer to the dilemma of what if the bond market does not act as so many are telling you. Same people have been wrong, by the way, for almost 2 years. And the bond market continues to act as if it's in a secular bear market, because that's what it's in. And it's been in one since interest rates went to zero in 2020. So to make this simple, like in a bullet point fashion, what is the end game of this bear market? Well, an end game to a bear market in stocks, which is what I'm talking about, is a new bull market in stocks. I think that'll happen. I think gold silver, and commodities will lead on that bull market, outperform the stock market. In fact, I think they will bottom before the stock market bear market ends. But bonds may actually continue to act bearish. They may not go up as much as people would expect. And the Fed may, in fact, lose control of the bond market, which would cause a stampede of people into gold and silver. So this is stuff to think about. And I'm going to be watching these markets very carefully once we get to the end of this bear market. I'm talking months from now. But I like to play these markets, not by loading up a Robinhood app and seeing what the daily gyration is and looking at what other people are doing and hurting myself into that, because that's not work. That strategy is a disaster when you're in a bear market like we're in. But I like to think way ahead and be ready for events way ahead. That means looking down the road at possible scenarios so I can be prepared if one or another thing happens. And I've just laid one out for you in this market. What if the Fed loses control of the bond market when they stop raising interest rates? So no one's going to ask that question on CNBC or just about anywhere else in the financial media, but we will. Here's the thing. If this is the first time you see me on YouTube, hit the subscribe button and hit the bell, and then YouTube will send you an alert as soon as my next video is up for you. And either way, hit the like button. I want to know that you're out there. And I'll be talking with you later. Subscribe and the bell.